all of you for taking the time out of this Saturday morning to attend this session. Let me set the context before I proceed. So we will just broadly cover the last 1 year. We have seen a lot of changes on the tax front, both on the personal tax front as well as what we have to deal on the investments front. It's more like a rationalization that has happened. So we'll just walk you through the varying different objectives. So this could be a little elementary also, and would probably help someone who's new to the investment journey. It is also to just highlight where there could be options where you could tweak. End of the day, we are doing any investment in order to be comfortable, in order to be financially free, in order to build that corpus, so that we can meet all our financial goals. So the objective is also to keep taxation in mind besides inflation. These are the two most important things that one should always ask before you step into any kind of investment, even if you're just parking your money in a savings bank balance, right? So the objective is to trigger that thought process in you that always have a perspective on the post-tax return. Am I really making money if I take into consideration? And with this kind of returns, where would I stand? So you need to understand while this topic we have kept it very focused and tried restricting ourselves to only the taxation part, but generally build in a perspective to have an overall thing on your asset allocation, how tax could impact. Okay, so without further wasting time, so if you most of you may be aware, there's quite a bit of information across social media channels, but we'll still through the key most important announcements that happened from an investment perspective last year budget, July 23rd, 2024, and there was no material change even in this year's budget that happened in February. Most important is indexation benefit was scrapped across most asset classes for long-term gains, capital gains. Okay, earlier we used to have about 20% taxation rate with indexation. Indexation benefit is no longer there, especially for debt, gold, kind of investment avenues. There's been a lot of uniformity in long-term capital gains tax rate. Earlier it was 10% for equity, it used to be 20% with indexation for maybe real estate and other gold and other asset classes. Now it's a standard 12.5% for long-term capital gains, and for short-term it is 20%. So the one good thing from, I would say, from a financial planning angle is your investments are more determined by what you need to do rather than a tax objective. Many of them used to put a lot of times earlier years. Slowly that's also changing, we are observing. Earlier years, a lot of the investments used to be driven by the tax benefits, but now it is you have to take a call on what the investment objective is, and accordingly, because all taxation rates are more or less the same now. Long term is 12.5, short term is 20, right? There's an they increase the basic exemption limit for long-term capital gains in equities. I'm sorry, I've not mentioned it as long-term capital gains, from 1 lakh to 1.25 lakhs. And there's been a pruning of, of the holding period. Earlier, we used to have three holding periods for long term. You used to have 12 months, 24 months, and 36 months. Now it's only 12 and 24 months. So a lot of improvement, lot of rationalization has happened, and we think it's in the right direction. Okay, so what are the things that govern taxation for investments per se? Okay, these are broadly the four things we'll cover across investment avenues. You'll also see how it works differently for different investment avenues. So it could be either your holding period. So you've held an asset for a particular time period, and that will determine whether it's a short term or a long term capital gain. For example, just for as an example, if you're holding an equity mutual fund, if you sold that particular units before 1 year of holding those units, it will qualify as short term. If you hold it for more than 1 year, it will be long term. specific investment avenue. So some investment avenues have their own rules. We will cover that. Quantum based. This is especially in the case of insurance, like tax-free payouts, where only up to a particular limit of premium is thing. ULIPs, tax-free payout insurance products. And there is also a completely exempt category. The number of completely exempt categories is I think only two as on date, to my best of my knowledge. Kindly correct me if there are more. So these are the different ways of looking at how the taxation could fall into the picture. So if you are taking holding period, I may be overlapping in the content because if it's more from an investment point of view, so there could be a minor overlap. Kindly excuse for that. So if I take holding period, long term and short term into consideration, okay, as we mentioned earlier, long term is 12.5% now, and short term capital gains is 20%. Okay. So short term is if your holding period is less than 1 year in case of some assets, and in case of other assets is 2 years. We will come to that long term. So this is how it works if you look at it from a holding period perspective. So I'll just cover two, three options. Equity and equity related products. Just in this example, if it is shares, mutual funds, hybrid mutual funds, which also qualify as come as the same rules as equity taxation. If you hold it for less than 12 months, the tax rate is about 20%. If you hold it for more than 12 months, it's 12.5%. In the case of equity shares, equity mutual funds, hybrid mutual funds, you also have the benefit of 1.25 lakh exemption. This is there for all listed products for that matter. If it's an unlisted product, unlisted security, unlisted bonds, debentures, and all that stuff, the short term period moves from 12 months to 24 months, and the tax rate is 20%. If it is long term, it is 12.5%. Okay. Now coming to the other category, this is more like debt. In debt mutual funds, there was a lot of confusion on what is the tax rate. Remember, there are just two things you need to remember. When did you, the most important point is, when did you acquire the mutual fund? The basic rule change for debt mutual funds came on in the 2023 budget. So it came into effect from April 1st, 2023. Okay. So if I bought a debt mutual fund, there are two parts. One, if I purchased it before April 1st, 2023, or I purchased it after April 1st, 2023. So have that clarity in mind. Now, if I purchase the debt fund prior to April 1st, 2023, okay, the rule now says that your short term is 2 years and you'll be taxed at slab rate, whatever is your income tax slab rate. If it is long term, if you've held it for more than 24 months, then it'll be 12.5% without indexation. So this is in case you bought that particular debt mutual fund before April 1st, 2023. If you've held it for less than 24 months, it will be at your income tax slab rate. If you held it for more than 24 months, then it will be 12.5%, but no indexation benefit. If you bought it if you bought the debt mutual fund after April 1st, 2023, no tension at all. You just have to, there is no short term, there is no long term for debt mutual fund. Everything is taxed at your income tax slab rate. The rule is similar for a gold fund also, gold mutual fund, I mean. So if you bought it before April 1st, 2023, right, and you're selling it sometime now, again, if it is holding period is less than 24 months, it is slab rate. If it is you've held it for more than 24 months, it's 12.5%. If you bought it after April 1st, 2023, it falls into the same category as most of the other unlisted assets. Short-term rate is, but in the case of gold, short-term rate is slab rate, but long-term will be 12.5%. Okay. So the date of your acquisition matters. Here, there are so many other debt and fixed income kind of products, which we will just touch upon, because many of us were investing into it or invest into it. So something like our most favorite of most investors, fixed deposits. The interest income, even if it is cumulative interest, will be taxed every year at your marginal tax slab rate. Okay, something like a Kisan Vikas Patra. It is where they say that the money would double in 9 years and all that. It's a very popular investment product. Even there, it's not tax free. Interest income is taxed at slab rate. In the case of a national savings certificate, NSC interest rates are linked to a lot of debt products like RBI floating rate bond and all that. Your interest income the first 4 years can be reinvested and can come under the ATC limit, but the fifth year is again fully taxable. One of the points that I'm trying to drive is where there is practically nothing that is out of the purview of tax. While these products are very popular, very many of them would like to have it as part of their portfolio. Many tend to do, I'm not generalizing, but many of them are not even aware that post-tax, this is the kind of returns I'm earning, right? We know, I think Kisan Vikas Patra today is 7.5%, National Savings Certificate is 7.7%. So post-tax, you're earning about 5. Fortunately, now inflation is at a low, right? I think the last inflation numbers, retail came in at about 1.5%. So we are in a comfortable cushion. We are in a comfortable environment. We will come to how why this inflation and why this tax rate matters with this very simple illustration. But when you're doing an investment into these products, scenarios change, which is what we are trying to tell you. See, there was a point in time when Kisan Vikas Patra, PPF and all used to go 12%. Probably inflation was still then about 6%. So these products made sense. So when as an investor, whether you're doing it now, you did it in the past, or you're going to do it, have a sense of what is my post-tax kind of return. So none of these debt products, the tax is, they're not without out of the tax purview. Everything is taxed at the tax slab. Coming to two areas where we get benefit, senior citizen scheme and post office savings scheme, up to under section 80 TTB, up to rupees, sorry, this is 1 lakh, I've missed a zero. Up to 1 lakh of interest income is free for senior citizens, similarly for post office. Okay. So these are some of the things that you need to take it into consideration. But please remember, this is also only under the old regime and this is not in the new regime. Okay, so even a senior citizen who's opting for the new regime will not have this particular benefit. This is all under the old regime. So two things that I would like to drive. All debt products, most of them, the typical popular investment ones, are taxed at your income tax slab rate, or there is a slight concession. So given that it constitutes a significant percentage of your overall assets, we have shown an asset allocation table also later. Have sense of how it would impact your returns post tax. Now, when we talk of debt, fixed income, there are also other popular products which we need to touch upon and cover. Okay, one is the ones that are completely tax-free, like your PPF, your Sukanya Samriddhi and tax-free bonds. Pub- Personally, I would always tell people to have a small allocation to Public Provident Fund in Sukanya Samriddhi for two reasons. PPF today, in today's context, gives 7.1%. Okay, it's a different issue that the government has not meddled with the rates for the last 3 to 5 years. It's been at all at 7% constant. And this is a personal opinion, not a house opinion. I'm just as a disclosure. I also think that going forward also, this particular investment avenue, given how popular it is, it will not be touched upon too much. You will not see too much of meddling, and very unlikely it comes into a tax net. If it does, it's a very, very bold measure by the government. Okay. Sukanya Samriddhi, again another political issue, political vote bank kind of a thing. It's a great product. It's giving you about 8.2% in today's context. I tell a lot of people with a girl children, and especially if they are below 10 years, to immediately open the account and start a Sukanya Samriddhi and try putting a lot of money, because who gives us 8.2% tax free? Okay, so have a small allocation into these two investment avenues. Tax-free bonds, good for senior citizens, but the interest rate, if you actually take the yield to maturity of such bonds, they don't cross 5.5%. So if you're comfortable with that, then you go ahead. Okay. Partially taxable is very recently, I think 2021, the government brought in a rule that any contribution to employer provident fund, okay, employee provident fund, the contribution by the employee in excess of 2.5 lakhs, whatever is the component will be taxable. The interest income will be taxable, and many of you may have also seen that it reflects in your AIS statement. So if I'm contributing 2,60,000, on the 10,000, that 8.25% interest that the government gives me will be taxed at your nominal tax slab. That is your income tax slab rate, which is broadly, let's for ease of assumption, let's take it as 30% or so. Okay. This is provided your employer is also contributing. In case your employer does not contribute to your EPF, then this limit of 2.5 lakhs goes to 5 lakhs. Okay. So these are partially tax-free product is an employer provident fund. The maturity of all these products are completely tax-free. Now we'll come to another popular investment avenue for a lot of people, and that is insurance. Okay. There are many types of insurance. One is money back and endowment plans. Practically every household will have an LIC policy or even from the private insurers of late. So money back and endowment plans, the maturity proceeds are free. The difference between is endowment, you normally get it as a lump sum. Money back, you get it at regular intervals. Very simple difference between the two. They are tax exempt provided the premium does not exceed 10% of sum assured, which is the case even when an insurance agent is selling it, they pitch it that way that you will get a 1010D benefit. This comes under the section 1010D benefit. So most of us actually land up also buying only that particular product. So they have a tax-free component. Annuities, on the other hand, are taxable. Okay, many investors tend to get into annuity products without knowing that you will be taxed at the marginal tax slab rate, right? So, but be aware that annuities are also taxable, unlike a lot of other insurance products. Guaranteed tax-free income plans. We like this product as one of your sources of retirement cash flows, and that's why I mentioned it here. Even in this, the government recently changed the rule, I think in 2022 or something, where they said, so guaranteed tax free cash flow products basically give you a regular tax free payout for maybe 20 years, 25 years, or 30 years, depending on the kind of combination product that you take it. Okay. They are the most attractive feature of this products is tax free payout. When we have retired, getting a tax free income would really help. As a country, also India, let us be aware that if we have a progressive government, we will slowly move to a structure where tax rates are attractive, but practically everything is going to be under the tax net. Tax is a reality, as we all get to hear. So our planning also should focus on that. So guaranteed tax-free payouts up to 5 lakhs of premium per year per PAN. The payouts that will start after 10 years or 12 years of premium payment will be tax-free. If it is more than 5 lakhs, the government has withdrawn the benefit and said that no, if your premium is more than 5 lakhs, then you have to pay tax on the payout. Okay, on a pro rata basis, of course. So when you're going in for if you go to your financial advisor or any agent is trying to sell you a guaranteed tax-free payout product where the premium exceeds 5 lakhs, be aware of this. Only up to 5 lakhs per PAN per year are the payouts come out of the tax purview. ULIPs, the government again recently, like what I just mentioned. See, if you observe how the tax budget, what announcements in the budget are coming, last 5 to 7 years, if you announce right from 2018, gradually a lot of things are coming in that under the tax net. In 2018, superannuation funds, which includes gratuity or EPF, everything, if the contribution, annual contribution exceeds 7.5 lakhs per year, then they said that will come under the tax purview. That time there was no, not many people realized it because not many people's contribution to superannuation funds typically exceeds 7.5 lakhs. Then in 2021, the government made that limit 2.5 lakhs for EPF. So now recently they have made ULIPs premium. If the premium exceeds 2.5 lakhs per year, or combination of multiple premiums. You take three ULIP policies and the premium of all put together exceeds 2.5 lakhs per year, then the amount that you will be receiving at the time of maturity is not tax free. Okay, only if your premium is below 2,50,000 will the maturity proceeds be tax free. So keep that in mind. Many of them like ULIP for one reason. One, it combines insurance and investment. You also get a life cover. At the same time, given how well markets have done over the last 15, 20 years, if you if you stay invested and you have a higher allocation to equity kind of investments, you really earn good returns. I mean, in the range of maybe 15 to 20% CAGR. So ULIPs is a favorite for many people. But remember, the premium, if you want to really build a good corpus, the premium amount should also be high. Your yearly allocation should be high. But if your premium exceeds 2,50,000 now in a ULIP, the maturity proceeds are not tax exempt. They will be taxable. Okay, at your whatever rules apply for that at that particular asset class. Yeah, so we have finished insurance. Real estate. Again, real estate, like debt, we need to keep in mind the time of purchase. So if I don't know how many of you recall last year's budget, they had completely withdrawn the indexation benefit. So there was a lot of hue and cry, and people protested, companies protested, saying that this is a very punitive measure, this should not be done. So the government ratified it, and now the rule is like this. If the property was purchased before 23rd July 2024 and sold anytime after that, your short-term tax rate continues to be at 15%. Long-term, you have a choice. This is only if the property was bought before 23rd July 2024. You have a choice. Either you can opt for 12.5% without indexation or 20% with indexation. But if you have bought a property after 23rd July 2024, the rates have been rationalized with other asset classes. Short-term tax rate is at 20% and long-term tax rate is at 12.5% without indexation. So again, like debt mutual fund, gold mutual fund, real estate also, when you bought the property makes a difference. Is it before July 23rd, 2024 or after July 23rd, 2024? We are not getting into detail of many products. Like even in ULIPs, there is a ULIPs or anything. There could be lot of subsections. Okay, but we are just giving you a broad indication on what is the taxation impact. If there is something very detailed that you need to get into at the time of filing, we would advise you to take the help of your qualified CA, so that because they will be more aware on how exactly the rules have changed. We look at it more from an investment perspective. So this is more to guide you and trigger you to look at it from a taxation angle also. But for something in detail, request you to go to your CA. REITs. REITs again is a product that is slowly gaining popularity. Remember REITs, again, as I mentioned, nothing is out of tax purview. So dividend and interest income, you will be taxed at your income tax slab rates. Capital gains, it's a listed product. So less than 1 year is 20% and more than 1 year at 12.5%. Here also you get a 1.25 lakhs exemption limit. Okay. And the third is rental income. So many REIT providers provide some kind of a rental income that is also taxed at your marginal tax slab rate. Sovereign gold bonds. Again, a very popular product over the last many years. Government has stopped issuing it over the last 1.5, 2 years if you have observed. So dividend income of annual income of whatever you get 2.5%, that is fully taxable. if you've held that sovereign gold bonds from till complete 8 years, till maturity, okay, the proceeds are completely tax free. You cannot redeem a sovereign gold bond before 5 years. But if you redeem between the fifth and eighth year, you choose to, RBI keeps declaring that there's a premature redemption window. If you opted through RBI's window, then it is tax free. But if you miss that RBI window and you sell it in the secondary market, then your long-term capital gains will be 20% with indexation. Okay, so remember this particular thing. If you hold it till maturity, it's tax free, right? But I think the last sovereign gold bond issue, if I'm not wrong, came in 2023 Feb. I don't recall after that. I may be wrong on this. The gold prices had already shot up so much, the government's burden had increased. So I think it's relevant for people who bought between 2016 and this time period. Yeah. So why have we done all this? What is the whole purpose again of understanding taxation? As I said, any return on your investment should help you build a corpus, should help you earn money over and above inflation, over and above tax. Inflation is a separate devil, which we are not getting into for this particular session. So we are focusing on tax. So your return on investment, less your inflation, less your tax, should that number should be greater than 1. Remember the simple rule, only then you're growing money. There are a lot of investment avenues. We'll come to that. I just maybe I've covered it also, like something like savings bank balance. We know so many people, just for the sake of comfort or not taking the initiative, have so much money just lying idle in a savings bank balance. If you go to these one of these bigger banks, like the top three bigger banks, they don't give more than 2.5%. Savings bank interest only up to 10,000 is tax free, and that too only in the old regime. We're all entering scenario because new regime is so attractive. All of us are opting for the new regime. Not many of us going for the old regime. So post tax, you will only get maybe 1.75, 1.8. Assuming inflation is about 4-5%, you're actually earning negative returns. Okay. So any investment, whether you're in savings bank, FD, your post office, your equity shares, whatever it be, ask yourself this should be a simple guideline. Post-tax, post-inflation, what is the rate of return I'm earning? Okay, we have just given a simple illustration to clarify this. Suppose on a fixed deposit, there are fixed deposits which are still even today, even after the reduction in interest rates, giving 7.5% on a yearly basis. I'm just assuming it's a small finance bank. If inflation rate is 4% and tax rate is 30%, you will get about 1.25%. This is just an illustration, okay? Similarly, for an equity mutual fund, assuming it's a diversified equity mutual fund, you get 12%. Post-tax, post-inflation, you get about 6.5%, okay? So yeah, this 1.25, we are actually, I've assumed 4% inflation rate at 30% tax. Today's inflation, as I mentioned earlier, also it's come down significantly. It's at about 1.5%. But if you see 2 years back, the inflation was at about 5.5%. And our FDs were earning maybe 7.5, 7%. So we were just about, maybe we were at around that 0 or 0.2, just about crossing the zero mark. You're really not making money by putting it into an FD. So what I'm trying to imply is you'll have to keep a tab of the interest rates, inflation, how things are changing, inflation. So you understand post-tax also, am I making money? Okay, that is the core central crux message that I would like to communicate in this session. So this is a financial plan and asset allocation table actually done for a particular client. And we have not included real estate. That person has a significant share in real estate. He did not want that to be included. But if you see here, his pre-tax, because it's only financial assets, the difference is only 0.8%. But if it was real estate also, it would have been significantly different. Okay. So if you see the difference in pre-tax and post-tax returns is coming to about 1%. Here it is also because he has a good share of like 8% into Sukanya Samriddhi. He has about employee provident fund is about 8%, which constitutes about 25% of his portfolio. FT is the one which is probably causing the reduction in the post-tax kind of returns. All of you can do this simple table and see. Pre-tax and post-tax, list down all your assets and it could be asset, whatever money, take even your savings bank balance, small FDs, recurring FDs, your NPS, PPF, put down, list down all your investments and have a sense, this is what I earn pre-tax, this is what I earn post-tax. As I mentioned, again, inflation is fine right now. So the 6.7% post-tax returns is okay. But if the inflation numbers are going to go up, ideally, a 2 to 3% over and above post inflation is something that will help you to build a corpus. Okay, so keep that sense in mind. Have a sense of your pre-tax and post-tax returns, and ensure again the same simple formula: return on investment should be greater than your inflation and tax put together. Some of the common things that we have observed, okay, again, I just mentioned savings bank balance. People tend to put a lot of money, just idle money lying in the savings bank balance. They don't see a necessity for investment. Probably they're comfortable with their and able to manage their daily living. They are okay. They don't want that hassle of increased investments. The only issue with that is you're earning negative returns post inflation. It will not hit you now. It'll hit you in the retirement phase, like how we saw with our parents' generation. Most of them kept it in FDs or in savings bank balance. They didn't let the money grow. While it was comfortable for them at that point in time, what they don't realize is when there is no regular income coming in, the lack of a growth in corpus or significant corpus will hit in the retirement phase. Okay. So instead of keeping in savings bank balance, while I'm not a big votary of fan of FDs or thing, I like hybrid mutual funds more. As an alternate, you can still keep it in an FD or a debt mutual funds, because end of the day you'll at least earn some 3 to 4% higher return instead of keeping it in a savings bank balance. Similarly, FDs, people park so much money in fixed deposits. I'm not saying it's right or wrong, but have a sense on post-tax returns again. When you park excess funds, you're losing an opportunity by just being a little flexible on your risk front, earning another 3 to 4% by just keeping it into a low risk hybrid mutual fund, something like an equity savings. If the time period is even less than 1 year, and if we have markets like how it is today, volatile, a very good option could also be arbitrage funds. Okay. So this is another mistake people do, where post-tax they don't realize that they're losing out an opportunity to earn that delta in earnings. Third, we have observed is debt mutual funds for systematic withdrawal. People park a lot of money into debt funds, thinking that it is safe, it is risk protected. They are not wrong. Nothing wrong per se. Also, see, your investment is also largely driven by your risk profile. But the point I'm trying to drive here is you park it in debt in a reducing interest rate scenario, right? From like from 7%, your return on debt funds may come down to 5.5%. Again, you're losing out an opportunity. Your tax slab is not going to change. You may still be in the same tax slab, right? So the first 1 year, parking it in debt to protect your capital for an SWP is good. But after that, try moving grade the hybrid funds. Like you can move from an arbitrage to a equity savings to a balanced to a dynamic asset allocation, and then maybe aggressive fund. You can increase the gradient, risk gradient of those hybrid mutual funds. Allow your money to grow is the point that I'm trying to drive. You don't need to keep it in a very safe place. A hybrid mutual fund will give you at least 7 to 9%, whereas an FD is you can say anything from 5 to 7%. Allow that extra delta returns. Okay, so don't look at for an SWP, don't look at only debt mutual funds. Hybrid mutual funds would be a better option. Finally, PPF. Many of them have, besides their EPF, they have PPF as their long-term investment retirement savings corpus. Nothing wrong with that. As I mentioned earlier, I very strongly vote people having little into PPF, little into Sukanya Samriddhi also, because they'll be the only tax-free instruments ever in perpetuity, according to me, in a country like India. But what one could also look at, if someone is of a low risk profile and does not want, look at NPS. NPS will still give you, you can probably have 70% into debt, corporate bonds and government securities, and remaining 30% only into equities, and still earn maybe 8 to 9%. If you look at the return that NPS schemes have given, it's a hybrid product. The returns have been really good across asset classes, especially if you have a blend. You would have easily earned returns between 8 to 10%, which is much more than the 7.1%. So if you have not introduced yourself to NPS, look at it as one of your long-term savings option. Besides PPF, I'm not saying scrap PPF completely. Besides PPF, also have this as one of your investment avenues. So these are some common things that people do. Putting too much into saving, lying, letting their money idle. I think it's a crime. Too much into fixed deposits, you're losing an opportunity where you can earn better. Putting too much into PPF, not even looking at NPS. NPS is a beautiful hybrid product, so take that into account. One second, I just finished. Okay. Yeah, asset class. So these are the different after coming to the observations, we know these are the different asset classes. Okay. What one should always do. So we come back to the same core point again and again. Everything should be goal based. Okay. Until and unless it is goal based, you will be making an investment. It's not that you would not be comfortable or you're not financially well off, but you're leaving the scope for it to be smartly managed, is what I would probably say, right? So have a goal-based perspective. So if it is a very short term, you can put it into liquid mutual funds or arbitrage funds. Okay, the return profile is more or less the same. For a short term, again, look at arbitrage. If it's more than 1 year, less than 1 year, look at arbitrage. The arbitrage funds qualifies equity mutual funds. Okay, if you put it into a debt mutual fund, you're taxed at your marginal tax slab rate. So for those who are on the 30% tax slab rate, yeah, if you put it in an arbitrage fund, you will still be taxed only at 20%. So even there, you will end up saving. So I'm saying those small tweakings, small changes will help you have more resources in hand for better allocation. Okay. Similarly, for the medium term is up to 6 years or so. Safely going for hybrid mutual funds, or you could also look at NPS as an option. FDs, the problem with FDs and all that is, even if you are not taking out the money, you're taxed every year, right? These funds, there is at least no taxation impact till you actually take out the money, right? So medium term, 3 to 6 years, allow your corpus to grow, give the delta of 1 to 2%. And equity savings category, you can save it's in the when post COVID between 20 and 24. Some of the equity savings fund, I'm not naming them, gave as high as 17% returns. It's an equity savings fund. They just have 33% into equity, 33% into debt and other opportunities. They gave 17% because markets did so well. So when there is a scope at a low risk for you to earn higher returns, don't miss out. Long term, keep a mix of your employee provident fund, your NPS, your retirement PPF, and you a lot into flexi or equity based mutual funds, because your corpus should also grow. There are some goals like retirement, children's education, children's marriage, where the corpus is really high. You cannot put everything into a very safe investment avenue. You cannot tie down everything into property or real estate. There should be a component of financial assets to it. So you should think. The point that I'm trying to drive is, if you look at the taxation rates across these asset classes, equity scores big time. Okay. There is a rationalization, but it is up to you to make that allocation, make that split, and ensure that you allocate your funds appropriately. We'll just put this, my colleague Tara will be sharing the presentation. Just give you an overview on the popular the tax saving investments like EPF, PPF, guaranteed tax-free income. I'm not getting into this because we have touched, we'll go to the questions if any on this. So few takeaways. Hybrid funds, again are more tax efficient. They, because they have an equity, they fall under the equity taxation rules. Okay, so between when you're evaluating, should I put it into a debt and hybrid funds, take the time horizon into consideration. If it's very short term, you can still go in for debt, but if it's more than 1 year, there are many hybrid funds which with the varying risk gradients that you can get into. SWP is a better way than any other option for regular payout because it also allows your money to grow. Taxation rates are lower when compared to debt options. And there is something called income arbitrage fund is a better option than an FD because the taxation again is much more beneficial. In an FD, you're taxed to your tax slab rate. Income arbitrage fund comes under, it's like the holding period for short term is 24 months and for long term is about 24 months. So your short term rate will be only 20%, long term will be only 12.5% when compared to 30% for an FD. Okay. So these are the broad things based on what the taxation is. Just have an understanding on how it works. Going forward, we will see a lot more rationalization, lot more easy way of doing things. If the kind of tax reforms that are coming in, this is very likely. The government is increasingly going to keep the onus of deciding where to put the money in the hands of the investor. It is not going to be forced tax savings like how we had even a few years back. Lot of things are changing. So understand this rationalization, understand the uniformity in asset taxation of the different asset classes that has come into picture, and accordingly take your decision. Very quickly, just a quick market update from our PMS team. So the last week was slightly better. The Indian indices staged a broad recovery. I think a lot of it was driven by IT. There's also talks of media, some talks of toning down of aggressive stance taken by the US on the tariffs front, and both the countries have expressed an intent to resume talks. So that also helped the market. There were FII outflows. FII outflows did not stop, but at least it was a lot more contained. Rupee continues to be at 88, 89, nothing great. But broadly, because of some clarity on the tariffs front, GST rationalization measures coming to the picture, and expected rate cuts in the US, we saw Indian indices do well in the previous week. This is how the global markets have done. There are other markets have done much better than us. Nifty was about 1.5% up on a weekly basis. But you can see Nikkei, the Japanese index, Hong Kong index have done much better than that. Sectoral update. Again, Nifty is the top performer. Most of the indices have ended in green, which is a very positive thing. This is just a weekly update. Our overall stand is you could see the market being a lot sideways. Again, we are a house which very strongly propagates goal-based investing. So we don't look at it from a short-term perspective, but this is more to understand and give a knowledge on how markets have performed on a weekly basis. Valuations, we are at par with the 5-year average if you see, or probably slightly still more expensive in some pockets. But if you're a long-term investor, if your time horizon is 10 years, we have seen such scenarios many times. One perspective that we would like to share, and this is more of a personal one. India's economy, if you take different agencies, different voices saying, it broadly ranges between 6 to maybe 7% kind of range. Most of them give an average number of 6.5%. It is the highest growth rate expected across economies in the globe. Even assigning even a probability to it, even the next closest would be around 5% or 5.5%. As a market, one thing we probably should accept and probably change our way of thinking is that Indian markets will always be expensive for at least the large cap stocks. So it's not going to get cheap or very reasonable in valuations. So keep that in mind when you're also taking into account these valuation numbers. So that brings us to the end. Thank you for your patient hearing. Again, the objective was to just, we have finished half the year. If you have not done a financial planning, please do one for yourself. Have a taxation based perspective on for all your investments. That's the objective behind. We did not touch the salary part because salary part is again a totally different, very big topic. So we just we focused our attention only on the investments front. Hope you found it useful. Very quickly about Right Horizons, for those who are attending this session first, we are a 23-year-old investment advisory and financial planning entity. We also have our own in-house PMS. It's close to about a 75-member team, and we manage 3,000 plus crores across various asset classes. We facilitate investments in FDs, bonds, mutual funds, PMS, as well as international products for those accredited investors. Our approach is always cash flow based and understanding the investment cash flow investment objectives of the investors. Anybody would like any assistance with this, you could reach either Tara or my credentials are here, or you could also log on to our website and reach out to us. So again, thank you for taking the time out. I hope there was some takeaway.